Hey there, YouTube. So for this video, I wanted to cover the IRS Schedule G that goes along with Form 1120. Right? Form 1120 is filed for C corporations in the U.S., and Schedule G is required to disclose certain types of shareholders that own a substantial amount of stock in the company. Okay, so we've got the form in front of us here, Schedule G example, but I've also got a slide here with some information, background info, and then the example, and then we'll flip back to the Schedule G, right? So starting at the top here, Schedule G has to be included if the corporation is answering yes to that one question. Well, it's two questions actually in Schedule K, which asks if any entity or person owns directly 20% or more, or directly or indirectly 50% or more of the total voting power of all classes of the corporation stock. Okay, and just to be very clear here, this is only used to disclose shareholders that have voting stock. Right, and that's important because the corporations will issue a lot of different types of classes of stock. Some will be voting, non-voting. Some will have more votes per share. You could have Class A with, let's say, 1 vote per share, and you could have Class B that has 10. A lot of different options in a corporate structure. So very important to only hone in here on the voting shares in the company. So if we look at our example here, we have Fake Consulting Business, Inc. It's a Delaware corporation, and it's going to be taxed as a C Corp for tax purposes. Right, and the reason why I highlight that is what we're saying here is this entity has not made an S Corp election. So it remains a C corporation for federal tax purposes, and it has the following ownership structure. So we have Class A common stock. Those are the voting shares by default. And then we have preferred stock. So Class A common, 35% held by XYZ Business, 40% by John, 15% by ABC Company Inc., and then 10% by Fake Cayman Islands Investment LP, LP being a limited partnership. So based on this structure alone, what we're looking at here, if we're answering the question yes, we do have shareholders that own directly 20% or more of the stock, right? We've got XYZ Business, and we've got John Smith here, okay? So if we flip back to the form, you're supposed to separate it between Part 1 and Part 2 depending on what type of taxpayer we're looking at. So Part 1 is for entities, right? These are foreign or domestic corps, partnerships, trusts, tax-exempt organizations. And then in Part 2, we have individuals and estates, okay? So Part 1, we list out XYZ Business Inc., include all the information on the shareholder. So the EIN for the company, this is for XYZ Business Inc.'s EIN. I know there's matching here, but again, I'm just using fake EINs here. Don't want to indirectly put any real ones in there. So in this, you would put the EIN for the shareholder, right? Type of entity, corporation, where it was organized, right? This business was set up in, let's say, Wyoming, so it's a U.S. corp. And then how much stock the shareholder owns, so 35%. If we go down to Part 2, we've got John Smith here. He's the individual. He's a U.S. citizen, and he owns 40% of the shares. Okay, so it's pretty straightforward. There's just a few things to really kind of focus on and highlight. Again, it's voting stock only. So we've got preferred stock here, 100% owned by Jane, taxpayer. But again, it's preferred shares, so she doesn't have any voting rights in the company. She gets preferential treatment on dividends, and if the company is liquidated, she'll be paid out first. But this is non-voting stock. So Jane, taxpayer, even though she owns 100% of this type of stock, it's not disclosed. Indirect and constructive ownership rules, very, very important here. Those can be found in 267C 1 through 5. Covers indirect and constructive ownership of stock, so family attribution rules, things like that. So if we look at just how this fact pattern would change a bit, let's say if ABC Company Inc. was 100% owned by John Smith. So these two line items up here, we have Class A common, John Smith with 40%, Class A common 15% held by ABC Company. What if John owned 100% of ABC Company Inc., right? If that were the case, then ABC Company Inc. would have to be disclosed in Part 1 because of the attribution here, right? The indirect and constructive ownership. So even though ABC directly only holds 15%, we can say that John indirectly holds more than 40 via this company, and so then that information would be disclosed. So in this case, we would list both John and ABC Company, and then the maximum percentage owned, we would put 55%, right? And so that would illustrate to the IRS that John beneficially owns 55%, and ABC Company more or less effectively controls 55% of the company as well, because of John's ownership stake. So, don't just look at the cap table and the shareholder registry to complete this form. You really need to have more information on the relationships that are happening between all the shareholders, right? Because you could have shareholders that appear to fall below the threshold, but then if you add up all their indirect and constructive ownership, you find that you will exceed those thresholds. So I hope that was helpful. Thanks for sticking through to the end here. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.